Hello, hello. This is the Accelerator. I am your host, Lera Kooper. The pun is intended. It's not that creative. My name is just in the middle of the title. But today we have a very special guest. We got Steve Gelley. He's the CEO of Blueprint Ventures and has successfully exited 2 business ventures. So we're going to get some great tips from him on the topic of how to view your business like an investor. So Steve, thank you so much for joining today.
For having for
Yeah. Yeah. And this is going to be a really fun one. And to kind of break the ice, get started, tell me, do you have any best or worst advice to share that you've ever received?
best or worst advice. Worst advice: don't pivot. I've gotten that feedback numerous times, actually from investors, where they would say, don't pivot your business. Pivoting shows that you're not really focused or you're not confident. Where that pivoting is the only reason why I had success in the business that I had. So that I would say would be the worst advice.
That's a good one. And hearing that makes me shocked to hear from an investor because in my mind, I'm always thinking, what's next? What's next? What's next? How do we stay ahead? Because the industry's changing, the needs are changing. And I can't imagine where we'd be if we didn't pivot multiple times.
I feel like pivoting is like that's the whole part of business, right? You
Yeah.
have to figure it out and problem solve as you're going. So if you're not pivoting and evolving, what are you really doing?
Yeah.
So, but yeah,
Well,
I was surprised to hear it, and I will never look.
yeah. Well, it's a good thing we're interviewing you and not whoever gave you that advice.
Well,
Well, with that lead in, you got to tell us kind of what's your story? You've had 2 very successful exits. So, as a founder, what was your experience? And then, kind of the other side of it, where are you today with your ventures?
yeah, definitely. So, actually, some good advice. My father, who I come from like a family of accountants,
Mhm.
grandfather and father, and good advice I had was my father said, if you don't know what you want to do in college, just go get an accounting degree because every business needs to run on accounting. And I was like, okay, that sounds pretty good. So I started my career in accounting. Actually, realized that it was hard to scale, like most businesses that have certain requirements and restrictions. Built one of the largest fintech accounting companies, um, these online players that are in the space, and then that went into mortgage processing, where we automated mortgage processing. Where my passion really is in workflow automation. When you look at any industry, systems and processes are so important, and you realize that as you're looking at all these businesses, you need to be scalable, repeatable. So automating as much as you can in a scalable, repeatable process drives pretty interesting results. So my second business sold to Remax Holding in 2015 or so. And then I moved to the other side. Well, I didn't think I was going to do anything, but you get bored very quickly. Uh, and moved into the venture world where ventures and now Blueprint Ventures. So I get to sit on the other side of it.
That's really exciting, especially with your unique experience. And it's very funny that your dad gave you that advice because I got the same exact advice going into college. I had no idea what I wanted to do. I was just very excited about learning. So if you don't know what you want to do, go into money because every industry has money. And sure enough, got into accounting, hated preparing taxes, and now I'm not doing any billable work. But with that knowledge, you're able to operate a scalable business. And that's really where your secret sauce has been is that automation. And had you not pivoted, you wouldn't have gone into your second venture.
Blueprint Ventures, um, you know, just the whole tech side of the world is a big pivot from where we all came from, like
Yeah.
10 years or years ago. So it's been great. Pivoted potential.
Yeah. So do you mind, can you share a little bit about your experience with your first exit and having investors come in? What were they looking for? And were you prepared for it as founder and someone that's in accounting? Or were there some things that caught you off guard?
It was a big learning experience going through the venture world. We were in Silicon Valley for about 6 months, doing the whole venture pitch pitch contests, traveling around. It becomes like this like circle, and you realize when you look back at it, you're like, what was I doing this whole time? I'm running around chasing money, you know, when I could have been running my business. And it's very distracting. Essential for some businesses, but 99.9% of the businesses do not need anything relative to venture funding or venture back funding or capital in general. There's a lot you could do with a business, and if you're a good business owner or CEO, you could figure out how to maximize and scale your business without anything. But yeah, we did it. Value that I got from going that route was really understanding my business and understanding what's important with these key drivers and these key metrics inside my business that helped shape every business that we've touched ever since then. You know, when you start to go into plumbing, doesn't matter. Like the plumbing business, there's going to be similar KPIs and similar metrics that as a business owner, you really need to understand so you can understand the pulse of your business and how you're doing and the scalability, where you could focus more attention to, where you could shift attention away to. So that process of just driving maximum efficiencies and driving KPI metrics and really benchmarking yourself was game changing for the rest of my career.
No, that makes sense. Is that something that you were already doing before investors came in, or is that kind of what jump started that habit for you?
I think gut feeling was what I was doing previously to that. I think having the investors, having to issue investor updates, you know, monthly investor updates, quarterly investor updates, updating pitch decks, getting ready for another pitch contest where you need to show, hey, we need to show traction, or our churn rate is too high and we need to really focus on churn between now and next quarter. It allowed me to be more, I guess, transparent with our team about what we're focusing on, when in the past it was going off of gut feeling. You know, as an accountant seeing thousands and thousands of customers, you typically could see financial statements and you do think in numbers. So you can dissect the business relatively quickly, but we're not always being transparent with our team about why we're doing this or what's going on there. And that's what the venture route really taught me, maximum trust, which I brought into my second. And that's solely why we were able to sell so quickly. I mean, it was about 18 to 20 months start to finish in that venture through due diligence to a public company. And it was all because our team had full transparency in every way.
That's a very interesting take on it, because I think so many business owners are private about their financials, whether because their cash flow is so good and they don't want to share that, or it's poor and it's a little bit embarrassing. So having learned that transparency, did you feel like you needed to share ownership with your team members to get the buy-in for them to go through the needed adjustments, or how did you balance sharing that transparency?
Hiring from the culture standpoint was like the biggest part. We wanted to make sure, you know, we were tech. Again, it was tech enabled services, and we were building out this tech enablement in an industry that's never really seen it before, right? For the mortgage processing side. So getting experienced talent that has that same mindset where they're not scared of a startup was very difficult. So the building of the culture process was number one. There is a big difference when you're building a company for a sale than when you're building a company as a lifestyle business, right? So for me to disclose every penny of profit that the company's making when your team is not seeing reinvestment back into your organization, starts to kind of shed lights. If you start, you know, crushing it and disclosing to your team that you're having record-breaking quarters and showing up with, you know, new cars and watches, it's a little bit different of a feel. So we were very transparent from the beginning that we're building the company and only the company. And for every penny that we make, it's going right back in to invest. And we want to build a monster in the space. And that's really where everybody kind of bought in.
Yeah, no, I can see that. And culture, we've gone through 3 mergers or acquisitions ourselves in the last handful of years, and culture and fit have become the priority over the dollar, because that's what can create drag in your business growth or really just spur it on exponentially. So that's an excellent point. Yeah. Um, so, having gone through that experience, now you're on the other side of the table. How has that shifted how you work with other founders that you're trying to support and get to an exit?
Yeah. Shifting mindset. A lot of times, a lot of people uh, just think that money's the answer to everything. If you go out and pull a bunch of first time founders or so, and you're asking them, hey, what do you need in your business to transform your business? Most of the time we're getting feedback. If I just had $1 million or $2 million in my business, I could grow it. That's not the answer. Money is not the answer. It's how it's being run. It's a system, it's the processes, it's the vision, it's making sure you can execute on the vision and having a well-oiled machine, which is typically your team, to be able to drive it. So um, it's different. I also understand the due diligence process that I went through. That was a nightmare when I was going through it as a founder. I understand it. I understand why the questions are being asked. I understand where the challenges are going to be in the business. I think it's okay. I think when I was on the founder side, I didn't think it was okay that my business had a weakness somewhere. We had a churn issue in one of my businesses. We were just losing customers. We're like, it is what it is.
Mm-hmm.
But on the other side, on the investor side, those are the areas I want to know. I want to know where you're having problems. I don't care what's great. Like whatever you're doing great and is working great and it's all, unicorns and rainbows. That's We can't pack that. We want to know where the challenge is, and then we can figure out how can we overcome them and our confidence level and being able to help you overcome those challenges. And that's the biggest difference.
Yeah. No, I think that's a very collaborative approach, and different than people's first thought when they think of PE or venture or just investors in general. The stereotype is you come in, you take over, and you kind of lose control of everything. Whereas with the right fit, they're coming in as problem solvers and a teammate. And it sounds like you just want to get to the root of the problem as quickly as possible, because that benefits everyone, both the founder and the investors that put their own hard-earned dollars into the company. Yeah.
Find the issue and solve all we do is problem solving. Business owners problem solve. That's all it is problem solving.
Mm-hmm. Just at a bigger level than the day-to-day operations. I just lost my thought. Good grief. Throwing good money after bad. I had that thought where you're saying, people are saying, if I just had another $1 million, if I just had that. So often people show their cards in the worst of times, whether it's in a personal relationship or business. How you react and handle poor situations is a very good indicator, I think, of what you're going to do with the next dollar. And so, do you have any thoughts on the throwing good money after bad, what people should ask themselves before putting more money into something?
They need to do the hard work before they put the money in. If you're properly going through expansion or growth in a business or starting a new business, you have to vet out these areas of risk, right? Like we said, problem solving. You have to get to those areas before it goes. And we've come across so many people that have put hundreds and hundreds of thousands of dollars into their business, and they'll come to us and they're just like, I'm 500,000 in and nothing's working. And we're like, how did you get to 500,000 in? What you learned with 500,000, if you weren't so emotionally evolved or emotionally attached to where you were trying to go, you could have done it with 5 or 10,000. Spend, test, learn. That's all across the board. So yeah, can't throw good money after bad, and you have to understand that when you're testing, that goes back to what I was saying before. Money is not the answer. If somebody says my biggest issue in my business is I don't have an extra $1 million to spend, that just means that they're going to lose $1 million to learn. But you could also lose $10,000 and learn the same lesson that you would have learned with $1 million. So it's that exact approach.
Yeah, no, one would hope. And we see that pretty often, throwing good money after bad, where it's, maybe you have issues in your team or production, or maybe you have who knows? And it's like, oh, we'll just hire a superstar employee. We'll just hire this. It's like, well, maybe the process is broken. Maybe like that's just the band-aid. It's not the root cause.
It
Yeah.
sounds like it's more expensive to
Yeah. No,
it's
totally make
cheap in the long run. It's like death by a thousand cuts. We say we see it all the time. In the long run, you're just temporarily fixing it. It's a big rubber band ball, and eventually it's going to burst, and
yeah.
that's where all the capital's going.
Yeah. Have you seen those like TikToks or Instagram Reels, YouTube Shorts where it's the watermelon and people just keep putting a rubber band on it over and over? You know, they got like 200 rubber bands on there and the last one, the watermelon just explodes. Yep. Yeah, death by a thousand cuts, same thing. Yeah. It's no, being a business owner is hard. It just requires a lot of active attention, and if you're not proactive or strategic or asking yourself these questions of, am I throwing good money after bad? What is the root cause? You know, what's causing me stress? You just turn into a leveraged employee, whether you have investors or not. If you're not getting out of the business a fair share for what you're putting into it, it's a tough spot to be in.
Yeah, I feel like a lot of business owners, it's so hard for them to get out of the box and work on their business, on their business. It's like it also comes down to personality too. A lot of times it's just control issues where in order for you to truly get out of the box and work on your business and not in your business, you have to have trust in your team, and you have to allow the team to kind of reach their potential as well, so that you can step back a little bit and see what's going on. And I think that's usually the biggest struggle when we're talking about small businesses specifically.
Yeah, that makes sense. And even I've seen even if the desire is there to work on your business, half the time owners don't know where to start. They go into business because they're really good at what they do. Maybe they're a plumber, maybe they're a software developer, and then they start growing their team. They start needing to manage cash flow, and they just being a business owner is a completely different skill set that you have to learn. And then developing your team is another skill set. And so it it's a lot that you have to continue to learn. From the VC side, you know, you coming in, you supporting founders, is that something that's typical for you to provide support on, you know, team development or implementations? Do you see that as a common need to help shift the owner's mindset from operator to working on the business, or are they already working on the business by the point that you're partnering with them?
No, most of our portfolio, we're taking that route. A lot of these small, you touched on it, Laura. A lot of these small business owners, they started in this space. They built their business in their space, in their industry, and it's very difficult to shift that mindset into what a CEO traditionally is. If depending on what you're trying to do, if you're building a lifestyle business, you know, go for it, right?
Mhm.
You could generate a nice income, but that's going back to what you said about essentially you're just an employee of yourself, right? So
Yeah.
um depends on the mindset of the business owner, but what we see a lot is most small businesses are being worked on and they're not being ran by the owner. And where they really need help is to bring in outside help, right? That's where you could be going. You could coach yourself up along the way, but you need to be bringing in that outside help, the consultant, the advisor, friends and family, whatever it is. Somebody needs to be stepping in to help them and guide them and structure these small business owners so that they can actually grow into the role that they need to do. They're not just going to snap their fingers and overnight, you know, go from a doer to, you know, a business owner like they should be. Not gonna,
Right. Yeah. No, that makes sense. Now, if a business owner, sans investor, is looking to just work on their business as their own investor, what do you think is a good place to start? You know, are there certain KPIs or reports or metrics they should be looking at to help them diagnose what needs the most help?
yeah. Um, Industry, I'm big industry benchmarking just because we're in, you know, when we were in a certain space, you tend to just know where you should be triggering to, but industry benchmarking is huge. It allows you to focus, not bite off more than you could chew either. And I think that's another big issue that's going on, and probably one of the biggest mistakes. Everybody tries to fix everything at once, and like, okay, we're going to
Mhm.
fix the retention issue over here, and we're going to get more growth over here, and we're going to fix our margins here, and we're going to hire more people. And there's so much to fix that nothing ever really gets done. But if you could start focusing on key metrics, core metrics, what do I need to do, and what's the scoreboard, right? Like business is just a scoreboard. Most people are managed the score by the cash coming in and out of their bank account. But if you start to manage a score based off of stats, right, of, free throw percentage, all that type of stuff, it's a completely different game because those stats of marketing, growth, metrics, all your margins, where you're kind of strive to, that's what makes up the scoreboard at the end of the game. And that's really where everybody needs to be focusing on, a little bit more of a micro level than that macro level.
Yeah, no, that's good advice. That's a great place to start, is just having awareness over what the score sheet looks like, and then starting to target what's going to make the biggest impact. Maybe where should we start? And I always say, oh, go ahead.
No, it's scorecards. Every business should have a scorecard. Like every single business you go into should have a scorecard, minimum of 5 things on that scorecard of what your entire organization is tracking, and it will be game changing.
Agreed. I agree. And something to be transparent with your team about, especially if it's departmentalized, having goals, whether it's OKRs or a score, it's all with the same intent. So then they know what they're accountable to as well. Yeah. So, and I think it's that hot of a take, but I believe every single business owner exits, for better or worse, whether they sell their business because they're burnt out or because they successfully planned for it, or just, who knows, you can get sick or COVID. So that said, if someone wants to set their business up for a successful exit, what's attractive to an investor? What's attractive to PE or venture capital when you're vetting out what businesses you want to invest in?
So venture capital is all growth. Throw a bunch of money around, see what sticks, burn out the founder, and either the founder's making them a lot of money or the founder's losing everything. It's like an all or nothing game. I'm not a huge fan of venture. For the founders or the owners of these businesses to really look for the exit opportunity, they need to understand their industry. They need to understand the target of who could potentially they sell to, right? Usually it's inside the industry. Very, very, very rarely is private equity going to come in and take over one of these businesses. So you need to start looking around internally inside the organization, inside your industry, who else is out there. That's where a lot of these mergers come from and succession plans are starting. And I feel like most exits come through some form of succession plan, whether that's new staff, new team taking over and the owner phasing out, or whether it's a merger or something to free them up. Then again, solving your problems, right? Finding out what your problems are, and then finding solutions where you could be a problem solver for other people. Maybe your business does one thing really, really well that everybody else doesn't do well. You become a lot more attractive because you can be an easy touch.
Yeah, no, that makes sense. And if someone is going through, say someone's looking at an exit, having gone through the experience yourself, do you have any tips for helping founders manage their expectations? Because a merger of any sort or bringing an investor, there's always going to be a shift in culture and there's going to be surprises. So how can someone that's never gone through it just manage their expectations and kind of protect themselves?
Going to take 90% of their time is their first expectation they can understand. It's almost like when you're like selling a house or a car, where like when you're looking to buy it, you feel like there's a million people that you're bidding against and you're in this bidding war. But when you're looking to sell it, you're like, where is everybody? What's going on here? It's very similar in the business space. That's how it works, right? There's an asset that you're selling, and it always feels like you're on the wrong side of the supply curve. So those expectations, patience, then finding the right deal. I feel like a lot of times desperate situations create desperate decisions.
Yep.
And you start compounding mistakes to the point where your business is just, completely, dug too deep and you're not going to be able to get out of it.
Yeah, no, that makes sense. We've seen a lot of that in our industry ourselves where people don't take time to work on the business and then they're desperate and burnt out. And either they sell at a low price or they just shut the doors and get nothing for their life's investment. And it's terrible for them, an opportunity for someone else. And it's it's wise to be proactive and not put yourself in that position. Yeah. Yeah. Well, I have to ask you, do you have any final tips for business owners that are looking to increase the value of their business?
Revenue is not the answer. Okay. With rising interest rates and everything else that's going on, the answer is sitting in your bottom line and your profit. So
Love it.
create a succession plan, make yourself the least important person in your business is hands down, and try and drive as much bottom line profit as possible that you could generate the cash flow. Think about the interest rates. You know, money was free a handful of years ago, and money is very expensive now. So in order
Mm.
for anybody to buy your business, you need to be generating a lot of cash flow to cover that debt that they're going to take on to buy your business, and they need a return. So make sure that you're replacing yourself in the business. You have your succession plan, and that bottom line is going as high up as possible to cover the debt service.
That's absolute gold. Thank you. How can people contact you, follow you, reach you, or, find you online?
I need always to help Steve at bpv.io. You could go to bpv.io and take a look at the website. And really any of your listeners who want any sort of feedback, I love talking about this stuff and we're here to help. So,
Yeah.
anything that you need. And if you have any questions that come across you, just shoot them my way and I'll pass them right back to your.
Awesome. Thank you so much for sharing. Well, thank you for listening in. Thank you, Steve, again. And this is The Accelerator. I'm your host, Lera Kooper, and until next time.